Joining us this morning to get the conversation started is Royce Mendes. He's Managing Director and Head of Macro Strategy at Desjardins, joining us from Montreal. Royce, good morning to you. Your reaction to the Bank of Canada move?
So my reaction was that the bank could have done a better job of communicating to the public and to markets that a rate hike certainly was in the cards. The inflation data came out. The governor had an opportunity to guide markets towards a June rate hike, and he didn't take that opportunity, and that's what I quibble with. Make no mistake, I have no problem with the fact that the bank raised rates. In fact, I believe that it's the right move. Inflation is proving to be far more sticky than anyone had anticipated, even with this many rate hikes in the rearview mirror. And there's probably more to come. The problem is that the bank really needs to be careful not to spook households and businesses and markets too much with these sort of surprising rate decisions. Rather do it more like the Fed. Get the market comfortable, get the public comfortable with what is going to be necessary to get inflation down, and then make good on your word.
So I guess that raises the question, does the BoC actually know what it's going to do? I only say that because, yes, I referenced David Wolf, former Bank of Canada advisor who we spoke with yesterday, who says they don't know what they're going to do because things aren't working as they had thought based on sort of a lot of traditional ways of measuring where we are. And going back to that pause at the beginning of the year, there was a sense that we had seen enough action to counter some of these concerns that they're dealing with, and clearly that was not the case.
Yeah, it's been an accumulation of evidence that we've seen that has not gone in the direction of the Bank of Canada's forecast. So I don't think it was any one piece of data, although the CPI data really was a major surprise to forecasters. But the bank could have done a better job in the interim of talking about the fact that June was on the table and they were prepared to hike, and then the CPI data, the GDP data surprised everyone to the upside. It came in hotter than forecasters anticipated, and that was the criteria necessary to pull the trigger on a rate hike in June. What's ahead? I think the bank probably has a pretty clear idea that the intention is to move rates higher. I don't think this is an exercise in fine-tuning. This is not a one and done in terms of rate hikes. They're likely thinking that it's going to take more to get inflation under control, and one rate hike is not going to be the difference between getting inflation to 2% or inflation remaining in the 4 to 5% range. It's going to take more than that, and I think the bank needs to prepare the public and markets for that eventuality.
I want to talk a little bit more specifically about housing because you have obviously so much household debt in this country, and I think that's one of the primary concerns every time you hear about another rate hike in this country. People sort of throw out these charts of how much debt Canadians now hold, a very different scenario than 10 or 15 years ago. And I do wonder, I can even share my own experience, Royce, having moved back to Canada 7 years ago and lived in big U.S. cities where there are big stickers on home prices. This is a very unique philosophy or mentality around housing. Is there moral hazard associated with the housing market in this country? Because you have to wonder why prices were moving higher on average in Canada during that pause period if we should have been anticipating the possibility of more rate hikes.
I think what's going on in Canada is complicated, but I'll point to two reasons why the housing market is probably rebounding earlier than many forecasters anticipated. One is that many lenders in the country aren't forcing the variable rate mortgage holders that have hit their trigger rate to pay the extra interest. So coming into the year, there was worry that the Bank of Canada had raised rates very quickly. There was a bunch of households in this country that was going to owe more interest than their fixed payment on the variable rate product that they had borrowed. And it was going to come to a head in early to to mid-2023. That hasn't happened. Another thing is the population growth. We knew that population growth was going to be strong this year, but it has been far stronger than anyone expected. And both of those things are providing a floor underneath the housing market, particularly the population growth. So many people are coming to this country, and people come to this country now more than ever with education, work experience, and capital, and they're able to afford a house in many cases. And so there is an underlying bid behind the housing market that will be there until until we see any slowdown in population growth, because the supply is simply not keeping up with the demand in the housing market right now.
I guess at the end of the day, though, like looking at the math of how much debt there is and where interest rates are, and depending on how long these rates stay at these levels, again, I mentioned yesterday, one of our guests saying this will end badly. How does this end from your vantage point?
I think David's probably right for a couple of reasons. One is that it's probably going to be necessary, unfortunately, to see a recession to get inflation under control. And secondly, the fact that people are not making all of the interest payments on their mortgages is not a long-term solution. It's just kicking the can down the road to the point of renewal when there is going to be a payment shock. We've done a lot of work on this. 2025 and 2026 are going to prove to be very challenging years for the Canadian economy, because there will be a lot of mortgages that will be coming up for renewal in those years. And some of those mortgages will actually have seen their principal not being paid down very much. And so the payment shock at the time of renewal could be huge, as much as 40 or 50%, maybe even more, depending on how high interest rates go. And so, whether it happens in the short term or a little bit further out, I think there is pain ahead as a result of all this debt we've accumulated. But it's pain more for individual households. The macro economy might be able to handle it only because of that strong population growth. So, the hope is that if we saw a recession at any time, it would be the sort of recession that was at the milder end of the range of recessions that we've seen in this country historically.